Within the tax code, there are rules and then there are exceptions to those rules, and often exceptions to those exceptions. What are some strange, bizarre tax rules that if you're not mindful of this, they could really cost you significant amount of extra taxes, draining your dollars? I've got 5 of them you need to be aware of. That and more coming up. The tax code here in the United States is by far the most complicated on the planet, and they're not handing out awards for that. We just, as citizens, need to figure it out. And the tax laws are changing, it seems like every couple of years. There's a really big sweeping tax law change that we now need to adjust to, and creates a very, very fertile opportunity for tax planning. Knowing the rules and using them to your advantage so that you can build wealth in a more tax efficient way. But the opposite can work against you as well. These rules come with nuances, and those nuances oftentimes, if you're not aware of them, they can cost you big. And by big, I mean you're paying more taxes, therefore you have less money in your pocket, you have less money growing for your financial future, and it can really be the dividing line between building a lot of wealth and not. So, there are far too many to count, like bizarre tax rules that you've got to be aware of. Otherwise, they're going to really wreak havoc on your tax planning. But I've got 5. I've got 5 that we've seen just this tax year, recording this right after the 2026 tax year. 5 rules that are unique that if you're not mindful of them, they're really going to wreak havoc on your financial life. The first one is that you have to be age 59 and a half to make an eligible withdrawal from your IRA and from your Roth IRA. If you withdraw dollars before age 59 and a half, you'll have to pay an early withdrawal penalty. And you might say, don't waste your breath. Why are you even talking about this? Especially this being the first one. Everyone knows this. Guys, they're serious about the half. That's why I'm bringing this up. Again, these are easy to miss tax rules that could cost you big. They're serious about the half. Believe it or not, we had an individual that we did their taxes this year. This is our first time serving them. And later in their career, not yet retired, but wanted to clean up some debt and thought, well, I'm turning 59 this year. And therefore, as long as I wait, I'll withdraw the dollars and I'll be fine. They technically didn't turn 59 and a half until January of 2026. They withdrew dollars from their IRA in December of 2025. They were not yet age 59 and a half, and that cost them an extra $2,000 of taxes. Withdrawing 20 grand, 10% early withdrawal penalty, $2 grand in taxes. They needed to wait just a month. They really mean it. I have no idea why they decided 59 and a half. Guys, make it 59 or make it 60. No one cares about the half. The IRS does. In order to make a eligible withdrawal, a qualified withdrawal from your pre-tax retirement account or from your Roth IRA, you've got to be age 59 and a half. Otherwise, there's an early withdrawal penalty, a 10% penalty that you'll have to pay. Second easy to miss tax rule that could really cost you big, and guys, this is a biggie, and that is when you're getting your health insurance through healthcare.gov and you're eligible for premium tax credits based on your income, it's looking at your entire year's income, adjusted gross income. So often, and we saw this a couple of times this year, so often you're working at a job and either you get laid off or you leave that employer and you don't have the next thing lined up. And because you left that employer, you left your health insurance behind as well. And you say, well, I need health insurance. So you go to healthcare.gov. They ask you, well, what's your income? And even in there, they ask you, well, what's your annual income this year? But you look and you're like, I'm not making any money. I'm in between jobs right now, and I only need the insurance when I'm in between jobs. I'm assuming when I get a new job, they'll offer me health insurance and I'll get it there. And so you say, very little income or whatever. And so when you say that, you're then getting a significantly reduced price for your health insurance that you're paying for through healthcare.gov. How that actually works is you're paying the normal price minus a tax credit, an advanced premium tax credit that gets trued up when you prepare your taxes. And so if you state for those 3 months that you're in between jobs, my income's only 20 grand or something like that, then you're going to be paying on a monthly basis a much lower amount than you would. And then, after 3 months or however long it takes, you get your next job. And then when you do your taxes, you've got your first 4 months of income from your prior job. You've got 3 months where you're unemployed, and then you've got, the next few months, the rest of the year where you've had earned income. When you do your tax return, if it shows that, no, you made $100,000, but you reported at healthcare.gov you're only going to make 20, well, you're going to have to repay all of those advanced premium tax credits. And this is where this is a biggie. I mean, it's thousands of dollars for many people. Like we saw that this would move the needle where you had to pay $5,000 back in taxes, and an enormous surprise at a time, likely when you had some financial hardship. I know there's still going to be arm wrestling over this throughout the year, but as a reminder, as of the time I'm recording this, there is now the ACA cliff, the Affordable Care Act cliff. So in the Affordable Care Act, you would be eligible in that law. It was written that you'd be eligible for these advanced premium tax credits as long as your income, adjusted gross income, was below 400% of the federal poverty level. During COVID, though, they turned that cliff that, hey, well, if you're $1 over 400% of the federal poverty level, then you've got to pay the full freight. They turned that cliff into a slope. And so even if you were over, just by $1, over that 400% of the federal poverty level, all of your premium tax credits didn't go away. You just got less and less and less. Well, they reintroduced the cliff this year, and it wasn't an act of someone. It was just the previous slope. It just expired. And Congress wasn't able to fix it, and therefore it's now back to a cliff. And this is going to cause even more financial pain or tax pain for those that, again, it's easy to miss and it could be very painful. Being mindful, it's your entire year's income that determines your advanced premium tax credit. Third easy to miss tax rule that could cost you big: RMDs on the 10-year rule. That's right, when you inherit an IRA or a pre-tax retirement account from someone that's not your spouse, starting 1/1 of 2020 and thereafter, that account now falls under the 10-year rule. There are certain exceptions. If you're an eligible designated beneficiary, and that's just a cluster of individuals where you've got different rules, but for everyone else, it's a 10-year rule. And you've got to empty that account, that inherited account, within 10 years after the individual, the original account owner, passed away. But starting last year, if that individual that passed away, that original account owner, was already past their required beginning date, it's 10-year rule. You still have to empty the account within 10 years, but you also have to take a required minimum distribution every single year. We've done a lot of content on this, really tried to communicate this so it doesn't surprise you, but this is a easy to miss rule. I just had a conversation with someone about this. Again, all of these have been top of mind from conversations or issues that we've faced with clients during tax season, and that can't really be how it works. I've got to withdraw it within 10 years, right? Yes, but you also have to take out a little bit every single year. If you don't, big penalties. They've reduced some of those penalties, even given some exceptions, but extra time, extra hassle, and you don't know if they're going to allow it. So therefore, just know the rules. If the individual that you inherited the dollars from, they're already past the required beginning date, meaning they were taking RMDs, you have to as well. And you've got to empty the account within 10 years. Fourth easy to miss tax rule, and this isn't so much a tax rule, it's just an easy to miss financial circumstance: side hustle income. And even more so, side hustle income that becomes main hustle income. When you are self-employed, you've got, revenue, and then you've got expenses, and it's hard to discern, well, what's the profit? What's going to land on my tax return? It's not always equal to the cash, because if you bought some equipment, you bought a lawnmower, you bought something, and there goes a big cash outflow, you may not be able to deduct all of that in the same year. And therefore, just looking at how much cash you have doesn't equal always the amount of taxable income you have. And so it can be very confusing. Well, how much income am I going to need to report on my tax return from the side hustle? But even more complicated than how much income is then how much tax. Because when it comes to side hustle, self-employment income, that sort of thing, there's no tax withholdings on those profits. And yet it's still going to be taxable, and it's a mysterious amount that's taxed, and therefore paying in the taxes, it is so difficult. It's more likely to get that wrong than it is to get it right. And just recently had an individual, and this just hurts, where they weren't doing proactive planning. Their side hustle became their main hustle. So what was about 10 grand in income was 70 grand in income this past year. No tax estimate, no tax, no adjustments to tax withholdings, huge tax surprise, more than in the 5-figure range, guys, more than 10 grand of tax surprise on that income. How do you overcome this one? Planning ahead. There isn't a way to just say, you know what, IRS, will you just withhold on the profits of my business? They can't. You've got to be working with your CFP who's working with your CPA to determine, well, what's the right amount to pay in and set aside for taxes so that you're not caught by surprise on your side hustle or your self-employment income. And then fifth, the last tax surprise that can really cost you big, and that is if on an old employer, if they automatically cash out your 401k. There are rules in place, many people don't know this, that if you leave an employer and you don't have a 401k of a certain size, that employer, that old 401k provider, could just cash your account out and send you a check. And when they do, it might seem like, oh, I'm getting a check for a couple grand. That's fantastic. No, guys, that's could be an early withdrawal penalty. Could be taxable to you if you're, depending on the nature of the account, if it was pre-tax contributions. Being aware of those rules so that you can roll those dollars over, sheltering the tax, not only can help you with your taxes today, but keep those dollars invested in growing compound for your financial future. The U.S. tax code is made up of rules, lots of them, and then exceptions to those rules, exceptions to those exceptions. You need a guide to help you keep it all straight and then really optimize your tax picture looking at all 6 areas of your financial life. Work with your CFP on that. If you don't have a CFP on your team, you can contact one of my team. Find us online, Korhorn.com. That's Korhorn with K, wisefinancial.com. You can find us here as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.